Hey, what's up, guys? John here. Do you want to know how the U.S. banking system is actually going to be going down? And this isn't an opinion. I'm not going to actually inject any of my own opinions in this video, maybe at the very, very end. But I want to show you what they are saying. I'm talking Reuters, New York Times, even Fed Now. I mean, all of these outlets are telling us exactly how a central bank digital currency will be released over the next 12 to 24 months.
The United States Federal Reserve is considering the creation of a digital dollar.
Central bank digital currency.
CBDC could offer a range of benefits and risks.
And how the public is not just going to accept, they're going to demand it. They're going to say, please give me the central bank digital currency. And they'll say, you know what, fine, we're going to give this to you. You know, we have to help and we have to protect the U.S. Financial system. And so this is what and how it's going to go down. I'm going to break it down. I'll give you all the facts. Please hit the like button. Hit the like button. YouTube will share the content. Educate more people about what's going on in America's economy. And if you'd like to fix your credit to position yourself for what I believe is going to be a major rug pull in the U.S. economy and financial system, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item on your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for Monday. I believe inside of this major transition, it's not going to be like a light switch. This major transition, it's going to take some time. We're going to see a great contraction of credit. So if you're thinking about getting any type of funding, make sure your credit score is in line with your goals. Take a look at this. So Reuters, April 25th, they said to prepare for failed clearinghouses. Regulators must equip themselves with tools such as bail-in bonds to quickly deal with failed clearinghouses for stocks, bonds, derivatives without having to call on taxpayers for cash, the G20 risk watchdog said on Thursday. Now, in 2007-2009, Dodd-Frank Act came out, and the Dodd-Frank Act said that financial systems, financial banks, institutions, they now have a vehicle called a bail-in, where if they're in a bad situation, they can bail themselves out of that bad situation with depositor funds. And this article, they say temporary public funding for liquidity should be relied on only as a last resort, right? So it's something that they're considering at the very least. Right? The fact they're putting this in there, I think, normalized the conversation. And then I saw this article, New York Times. This came out May 23rd, right around Silicon Valley, Signature Bank, First Republic, PacWest getting acquired by Bank of California, all that chaos that unfolded in March, a couple months later, what they suggested about clearinghouses. So about the same exact subject that they're now warning about. They're literally providing the solution to the problem that they are now talking about April 25th. Now, May 9th, they said, as the ripples of the regional banking crisis are felt across the financial sector, regulators are raising the alarm about the risk to another corner of the market, clearinghouses, the middlemen that facilitate trades and deposit billions of dollars in banks every day. If a bank failure were to leave one of them without access to cash, widespread market instability would follow. Why take that risk? Clearinghouses exist to mitigate risk, taking collateral and settling transactions between buyers and sellers in all kinds of financial markets. This means a bank's failure could easily lead to losses for a clearinghouse that could potentially reverberate across the financial system. And so they say right here, even with a complete failure at a commercial bank, delays across access to cash could trigger liquidity issues across markets. The Minneapolis Grain Exchange is not a systemically important entity to the U.S. financial system, but they may have billions of dollars in margin. At the end of the day, they don't have a place to safely secure it. And so they said, regulators say there's a simple fix. Allow more clearinghouses to deposit their cash directly at the Fed, right? Deposit their cash at the Fed. And so if you look at the framework of how Fed now works, they essentially it's buyer and seller right here. And then you have the third parties, the banks, the clearinghouses, and then you have Fed. So they would be able to start depositing their funds directly here. Now, in the event that we start seeing bank failures, like what they are literally talking about, I mean, they talked about this 2 days ago, right? Why hundreds of U.S. banks may be at risk. When you look at the FDIC insurance, they have about 1% of all deposited funds they would be able to actually insure. And so what I think is very likely is when you start to connect the dots with these the BTFP, Bank Term Funding Program, that is $161 billion question mark. You have, 1,804 banks. I believe it's 1,804. Yep, 1,804 banks that tapped into this lending facility that now have to pay back this money. Right? They have to pay back this money. Most of these banks don't have the money. And so you're going to start seeing a lot of banks go down, right? Without doubt. If they don't have the money, they're going to be insolvent. They're going to be consolidated. And so what I think could happen is we could see a lot of depositors, certain institutions, lose their funds. And this story will likely spread like wildfire throughout social media and mainstream media. And as people start to see X, Y, and Z, and Mary, and Sam, and all these different people, they'll put individual faces to the losses to really drive home that emotion. People will say, you know what? We gotta find a better way. We can't do this. We need a safer solution. And so, bada bing, right here. That would be the safer solution, right? And so when you start to look at this, you're like, all right, well, May 3rd came out yesterday, a third of office mortgages packed into bonds are at risk of default. A third, right? You start to just kind of connect the dots here. And this came out as well, came out 4 days ago, 5 days ago. It says Republic bank seizure signals more bank failures to come, right? More bank failures to come. And I find it very fascinating. You look at Deutsche Bank stock fell 8%, about last week, right? It fell 8% last week alone. And so you start to kind of look at all this and you see all these changes unfolding right now in the U.S. economy. And there's no other way that this doesn't happen. I wish it wasn't the case, I really do. But when you have 80% of all commercial real estate loans held by regional banks, and regional banks are the ones that really exercised that Bank Term Funding Program, those loans, and you start to hear the conversation about these clearinghouses, it all signals a major change to the U.S. financial system. This is what it signals. I mean, they have to pay back their money in full. Some 1,804 depository institutions tapped the emergency lending facility set up last March in the wake of Silicon Valley Bank, amounting to about 20% of all eligible firms, Federal Reserve said Monday. About 95% of borrowers, which included banks, credit unions, savings associations, and branches, and agencies of foreign banks had less than $10 billion in assets, the U.S. Central Bank said in its semi-annual financial stability report. The Bank Term Funding Program, as it was called, was aimed at addressing the liquidity crunch after a run on depositors led to the failure of Silicon Valley Bank, Signature Bank, and forced financial authorities to stage a rescue of the sector. Now, I wouldn't say it was a rescue. I would say it was a setup, right? Well, let's call it what it is. Think about this. These banks, they're sitting on, let's just say, for example, they have an office loan, and this office loan was based on an asset that they thought was worth $100 million. So they gave a 70% loan to value loan on it, maybe 10 years ago or 5 years ago. And now that $70 million loan, or that $100 million asset, is worth 40 to 30 million, right? So they're underwater $40 million on that loan. What the Bank Term Funding Program did was say, you know what, look, we're going to give you your $70 million. Forget the $30 million loss. You don't have to realize it now. We'll give you the 70. And so these banks are saying, great, we can replenish our losses. We can figure it out. We can try to find a solution when they cut rates. And they're not going to cut rates. And so what's going to happen? Slowly but surely, these banks, when the Bank Term Funding Program, when they come knocking on the door for their money, they're not going to have it, right? And so you start to just kind of connect the dots here. How do we not see widespread banking crises unfold here, right? Like, there's just no way that this does not happen. And when they put this article out talking about failed clearinghouses, saying that we need to deposit the funds directly with the Fed, it just signals one clear direction here, that this is how, they literally say it could usher in new U.S. payments, right? This is how it's all, I believe, going to be unfolding here, 2022, right? This has kind of been going for a little bit now. And so as this gets rolled out, you have to ask yourself, is this just going to be like a light switch? I don't think so. In fact, what I believe is going to happen is I believe it'll be in the beginning like a great solution. Everyone's going to love it. They're going to have more, almost everyone is going to love it. They're going to have more confidence that their money is safe. But over time, the game's going to change. Gradually but surely, over time. Just like the world. Like, look at how much the world has changed gradually but surely over time. Over the last let's just call it 4 years. Same thing will happen here. So I believe the next couple of years are going to be extremely important to build wealth. But just know that the door's closing on building wealth. So over the next couple of years, you want to be very, very strategic and smart and make really, really smart moves. Put yourself in the best position possible, because trying to build wealth from zero or in the negatives in 2026, 2027, I think is going to be a really uphill battle. I mean, even right now, it's an uphill battle. Let's face it, everything is extremely expensive. But watch as this unfolds. You'll see. 2027, it's going to get really, really challenging. I mean, they say that you're not going to own much. In fact, nothing is what they said, right? So, and that's in 5.5 years. So you want to really use the next couple of years to your advantage to build as much wealth as possible, because I think we're going to see a lot of volatility, we're going to see a lot of problems, and we're going to see a lot of change for America. Drop below. Let's have a conversation about this. And if you'd like to fix your credit to position yourself for funding, we would love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative item in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free call for Monday. Catch you next video.